all right. Happy Jobs Day, everybody. It's a good Friday. I mean, unless you're long stocks, then maybe it's not such a good Friday. But welcome into Market Takes. I appreciate you all joining me. I know you could have been anywhere in the world, but you're here with me. So I want to say I appreciate that and thank you for joining us here on Market Takes right here on YouTube. I am Dion Rabouin, reporter at the Wall Street Journal. We are breaking down, diving into, and dissecting all things about today's non-farm payrolls report for September. We're going to talk about the big takeaways, all that good stuff. We are going to get into all of it from today's jobs report, why it matters, what it means, what we're looking for going forward. We're diving into all that. So again, thank you for joining us here on Market Takes. Look, today we're going to talk about obviously what the headline number was and how that was compared to expectations. Talk about the market reaction, look at stocks, bonds, crypto, FX, commodities, all that good stuff. We are going to talk about what the number means for the economy and, very importantly, what this number likely means for the Federal Reserve. We're going to talk about what it says for inflation, and we're going to talk about what the number and what some of the little pieces in there within the jobs report tell us about the likelihood of recession. And last but not least, we're also going to talk about what to watch for next, because obviously this isn't the end. This is, just the latest piece of data that we'll get. But important to keep in mind, this is the last jobs report that the Federal Reserve is going to get before their meeting in November. The Fed's November meeting is November 2nd, before the jobs report comes out on November 4th. So this is the last jobs report they're going to see before they make that decision during their two-day meeting, November 1st and 2nd, and we get that report on November 2nd. So this is a big report. Let's get into it. Let's just dive all the way in right now. No more time wasting. The report showed 263,000 jobs added last month versus expectations of 255,000 jobs. Basically a little bit over, or 250,000 jobs, a little bit over expectations. The fact that it was 8,000 or 15,000 or 8,000 or 13,000 above expectations doesn't really mean that much. The bigger deal is that we are down from August when we had 315,000 jobs added, but not that much, just a hair down. And we know that the Federal Reserve is looking for the labor market to cool down. We're going to talk about all of that in just a second. So slightly stronger than expectations on the job report, as we've seen from the market, maybe not slightly better than expected, which is usually what you say when you add more jobs than economists had predicted, but slightly stronger, and I'll get into all that. Real quick note, the Bureau of Labor Statistics did point this out in their report this morning. Hurricane Ian had no discernible effect, that's a quote, on the employment and unemployment data for September. Basically, that hurricane made landfall after the unemployment data had been collected. Researchers there saying this didn't reduce or increase. That's not something that folks need to be worried about with this report. Definitely something to watch for in the October report when we get that in November. But right now, Hurricane Ian, the devastation down there in the southeast, Florida, South Carolina, and that region did not affect the jobs report numbers for this month. So that's not something you need to take with a grain of salt. So look, let's talk about the big elephant in the room. That's the Federal Reserve. We know the Fed wants the job market and the labor market to cool down, to kind of slow from this torrid pace of hiring that we've seen. Now, why is that? Well, in the Fed's eyes, we've got unemployment getting down to low levels, below historical norms, and that's keeping a lot of pressure on wages, which is going to keep prices elevated. If folks have more money, if they've got more power to demand raises, to increase their salaries, they're going to keep buying, keep spending, and that's going to keep prices going up. This is it's a vicious cycle where, prices rise, but if folks can keep paying those higher prices, well, the prices will just keep on rising. The idea is the Fed kind of wants consumers to tap out, really just say, okay, you know what, things are getting too expensive, I can't afford this, I'm gonna stop buying these things, stop buying those things. As companies see their sales reduce, they start to cut prices because they say, oh man, we can't just keep raising prices like this, no one can afford it. And that's what brings inflation down. Now that's at least, kind of how we've heard it explained by Fed Chair Jerome Powell and some other folks on the Federal Reserve talking about why they want the job and labor market to cool down. Now, some economists disagree. They say, hey, look, Americans on the labor front have lost so much negotiating power, have lost so much power to demand higher wages, even as prices for things like college, medical care, housing, and all that have really just spiked and skyrocketed out of control. Folks, their jobs and their salaries have not kept up. This is a good thing that Americans are finally starting to catch up, and you guys destroying that labor market, that strength in the labor market, is going to do more harm than good. We're seeing more and more economists start to come out with kind of that view, and we've seen some big organizations start to say, hey, maybe you guys are doing too much. We're going to talk about that a little later. The most important piece of this report, I think really, if you're going to talk about a big takeaway, is that we saw payrolls grow by an average of more than 440,000 jobs during the first half of this year. That is a huge number historically, 440,000 jobs average per month over the first 6 months of the year, over the first half of this year, locked in now after these revisions and after this report through September. So that's a big number, much higher than average, and suggests that this labor market is really not cooling down as the Federal Reserve has said they would like to. I'm going to read you a quote from an economist, Tom Simons at Jefferies. He says, quote, "There is not a lot of capacity for the labor force to grow, and thus strong wage pressure is going to continue to be an issue. We still expect another 75 basis point rate hike in November from the Federal Reserve." A lot of Fed speakers have come out over the past week or so and really kind of said, we have a lot more to do to slow down inflation. We saw that CPI report earlier this month earlier last month, we saw it for August, which said that inflation is still rising at 8.3% year over year, even though it is slowing down month over month. So the Fed's still worried about inflation, and clearly this report has not done a lot or really anything to assuage that worry or to make them say, hey, you know what, okay, this is finally having an effect. Now we might want to slow down, and that's probably the big takeaway. So let's step out and let's hear from or look into the market. I'm logging into WSJ.com right now. We've got the market finally open right now, and we are seeing kind of across the board stocks down. Like I said, if you're long stocks, today's jobs report probably didn't make you very happy. You've got the Dow, S&P, NASDAQ all down by more than 1%. The NASDAQ actually down by 1.8%, down almost 2%. So watch out for that. We might see another day of a lot of red on the market. After we started the fourth quarter, the beginning of October was really strong. You saw stocks bouncing higher, led by some of those high-flying tech stocks and growth stocks. It looks like we're seeing a reversal of that after this jobs report that really just locked in the fact that the Fed has the cover that they need to continue being aggressive, maybe another, and likely it seems as far as the market's concerned, another 75 basis point rate hike for the Fed at its next meeting in November, based on what we saw from this report. One of the more interesting pieces of the market that I was looking at was the bond market. You guys know, if you follow me, I love bonds, baby. Bonds is where it's at. The Treasury market spiked up really across the board, kind of rising at the longer dated, the shorter dated, even in the middle, all by around 6 basis points. So you're seeing those longer dated yields pick up. That means expectations for more inflation, but also for more growth. So those recession worries that have really been bringing yields down at the longer end of the curve, 10 years, 20 years, 30 years, that's kind of being priced out after this jobs report, because there still looks like there's strength in the economy. Employers are still hiring. Wages are still rising, not that fast, not as fast as overall inflation, but wages are still rising, and the likelihood of a recession, it looks like the market right now, at least in response to this jobs report, is lowering those expectations. We had seen the 2-year yield, which is most responsive to those expectations for the Federal Reserve rate hikes, really tick up and jump higher than the rest of the overall yield curve. That rose to 4.33% earlier today. It's come back a little bit from that, but towering over yields for 10-year and 30 years. The 30-year bond is at 3.85%. The 10-year is at 3.89%. So again, you're looking at about 30, 35, 40 basis points of difference between the 2-year. It's higher by about 40 basis points than the 10-year and the 30-year. That suggests, again, worries that the Federal Reserve is going to keep raising, keep being aggressive, while that economic growth is not going to do as much. But today's report suggests that those worries have been lessened just a little bit. It looks like the labor market and the economy are stronger. When we look out across the markets, you're seeing the dollar a little bit stronger there. You're seeing some weakness in the yen, the euro, and overall currencies versus the dollar. Dollar's taking up just a little bit, but remember, we are at some of those all-time highs that we reached, or we're near those levels of all-time highs that we reached in late September. The crypto market really just selling off, suggesting that yes, it's expected that the Federal Reserve is going to do more. We've seen crypto really tied to those Federal Reserve rate hike expectations really over the last couple months, well, longer than the last couple months, really over the course of this year. So we've seen that. Really, what the market is telling us today, they expect the Federal Reserve to keep being aggressive, to be locked in, to raise rates probably around 75 basis points again in November, or at least 50 basis points, which is twice the normal rate that they've hiked at, this millennium. And that is going to continue to do some damage to a lot of these markets and potentially to the overall real economy. Now, the sneaky important piece of data that I found in this report, in the jobs report today, was that drop in labor force participation. We had a big spike up in labor force participation in August, and you saw really a lot of folks coming into the labor force, a lot more people coming off of the sidelines, as they say. Well, you saw a kind of reversal of that 0.2% increase in August. This month, really fully reversing, and the number of unemployed people rose while the number of people not in the labor force also rose. So less people in the labor force, less people employed. That's why you saw the drop in the unemployment rate. That's not necessarily a great thing. Across the board, really, we've seen data deteriorating. We've seen consumer sentiment declining after that big pickup we'd seen since June. Purchasing Managers Index. Basically, they talk to businesses. How's business? Is it better? Is it worse? It's starting to get worse. We're starting to see those numbers contract both in the US and globally, especially on the goods side, on the manufacturing side. On the services side, we've seen just the opposite, a real pickup, a significant increase, and services make up a lot of the US economy, about 60, 70, 80%, depending on which survey you look at, but that's really been a big difference. Also, pending and existing home sales. Pending home sales this month, we just got the report, last month when we got the report this month, down 23%. Durable goods orders have been down. Various Fed manufacturing surveys across the board, Kansas City, Philadelphia. When you look at all those different parts of the country, you're seeing a consistent trend downward. That's what the Federal Reserve wants. They said they're ready to take us into a recession if that's what it takes to get inflation down. But again, the deterioration of a lot of data, but we did not see that in today's jobs report. So that's why you're seeing, I think, a lot of the market action that you are. Now, a lot of these layoffs at Amazon and Peloton, which just came out today, have really taken center stage. Also, you had the hiring freeze at Facebook. Those have gotten a lot of attention. But when we look at this big picture data about the US as a whole, today's jobs report tells us companies may be slowing their hiring. They may be laying off people a little bit, but we're not seeing big wide-scale layoffs. We're not seeing net job losses. We are seeing net job gains continuing at a large and a pretty fast pace. The Challenger job cuts report showed layoffs fell 20% in August. That was the second month in a row of declines. You also had the initial jobless claims report earlier this week showing that jobless claims rose to the highest since the last week of August, but still well below the long-term trend, and they just hit a 5-month low last week. So layoffs really have not been a thing. We did see in the JOLTS report, the job opening and labor turnover survey, that the number of job openings employers had dropped by over 1.1 million jobs in July, but that seems to be the trend. Employers are just doing less hiring, not more firing, not more layoffs, not cutting hours. That's a good thing for the economy. That's a good thing for the American people, you and I, out there working our jobs. But it's not great when you look at what the Fed's going to do, and that's what the market is responding to. And that tells us a lot about the big picture and what we can expect moving forward. Now, wages are still rising by about 5%. We saw average hourly earnings rise by 5%, but again, that's well below the 8.3% pace of inflation that we saw for the month. So, average hourly earnings are, consistently at that 5% mark. They've really come down from about 5.5% earlier this year and last year to that lower level of about 5%. And That's part of why these economists are saying, hey, Fed, maybe you should check out these numbers because earnings and salaries and wages are not what seems to be driving inflation right now or an increase in those things. The IMF last week said a wage price spiral is unlikely, saying that labor costs are not the main driver of the recent bout of inflation. Rather, that wages and inflation are being pushed up by separate, if also related factors. That's a big thing. Also, the United Nations, the UN coming out and saying, hey, Fed, you're doing a lot of damage to the global economy. All these other countries out here that have a lot of debt, they've borrowed a lot of money in dollars. The value of the dollar is getting stronger, it's getting higher. That's making the amount they have to pay back even higher, and that's hurting their economies. And we could see now the UN is predicting, the IMF is predicting a global recession next year. And that could be more damaging if the Fed continues to be aggressive. And when you look at this jobs report today, that likely backs the case for, like I said, more aggressive action from the Federal Reserve. Listen, that I think is all we're going to talk about today on the jobs report front. But I know you are going to want to be here tomorrow. Sorry, not tomorrow. Tomorrow's Saturday. I'm going to be off. I hope you'll be off as well. I know you're going to want to be here on Saturday, Sunday, Monday is the day that I will be right back here on Market Takes. We're going to be looking ahead. We've got producer price index. That's the PPI. That's what businesses are paying. Business or wholesale inflation. That report is coming out that week. Consumer price index, CPI, that is the big one. That's what the whole market is watching these days. That's coming out next week. We've got a number of other pieces of important data. I will be breaking all that down right here on Monday on Market Takes. I hope you will be there and won't be that's a square, don't do it. And we'll be breaking all that down. So appreciate you being with me today on Market Takes. We will be back doing it live right here for the Wall Street Journal on Monday, and I hope you'll join me. And yeah, that's going to do it for Market Takes today. I'm Dion Rabouin, reporter at the Wall Street Journal. Thank you so much for being